You open your mailbox on a Tuesday afternoon. Inside is a letter from your insurance company. You haven't filed a single claim in 11 years. Not for a broken pipe. Not for a fallen tree. Nothing. The letter says your policy will not be renewed. That is not hypothetical. It is happening to homeowners across the country right now. And here is the answer the title promised. Your insurer never needed you to file a claim to drop you. They bought a score, a third-party data product built from your property's claims history, satellite images of your roof, and a credit-based risk number, assembled without your knowledge and sold to insurers by a company called LexisNexis Risk Solutions. The database at the center of this is called the Clue Report. Comprehensive Loss Underwriting Exchange, LexisNexis maintains it. And according to the company's own product documentation, 99% of U.S. home insurers use it. It tracks claims tied to your address, including claims filed by previous owners or by your neighbors on shared property. You never filed a claim. Your neighbor did. That inquiry lives in the database. Combined with aerial imagery software that detects roof discoloration from space, and a credit-based insurance score built from your financial history, the system flags your property as a risk before you ever cost them $1. Bernie Birnbaum, executive director of the Center for Economic Justice, documented in 2023 that insurers now feed more than 130 non-claims factors into their underwriting algorithms. Roof age detected by satellite is one of them. What makes this different from a standard rate increase? You have no legal right to see the specific score that ended your coverage. LexisNexis charges insurers for access to that data. The insurer uses it to exit you. LexisNexis profits either way. This is not primarily a climate story. Climate is the cover. The real engine is data monetization. A business model where a private company sells risk predictions to insurers, and the homeowner is the product being evaluated, not the customer being served. Doug Heller, Director of Insurance at the Consumer Federation of America, testified before Congress in 2023 that claim-free homeowners with lower credit scores pay significantly higher premiums, sometimes for properties that have never generated a single payout. The score penalizes the person, not the property's actual history. In January 2023, LexisNexis settled with the Federal Trade Commission over violations of the Fair Credit Reporting Act, the law governing how consumer data can be used in financial decisions. The settlement required the company to fix accuracy problems in Clue reports that had been used in underwriting decisions across the country. The receipts exist. CFPB complaint records, State Insurance Commissioner filings, LexisNexis's own product pages. They show who built this scoring machine, how much money moves through it annually, and which companies profit every time a policy disappears. The next chapter breaks that down. 3 separate data products, 3 separate companies selling them. One composite score that decides your fate before a human being ever reads your file. The first layer is the Clue report. LexisNexis, the same company that sells legal research tools to law firms, maintains a national database of property claims going back 7 years. 99% of U.S. home insurers query it before writing or renewing a policy. Every claim you ever filed lives there. But here is the part that stops people cold. Claims you never filed live there too. A neighbor calls their insurer to ask a question about storm damage on your shared block. That inquiry touches your address. It gets logged. Your Clue report now shows activity on your property even though you made no claim. Paid nothing, lost nothing. The second layer is the credit-based insurance score. Not your credit score, a different number entirely. Doug Heller of the Consumer Federation of America testified before Congress in 2023 that this score uses over 130 non-claims factors. Payment history, account age, credit inquiries. All of it predicts whether you will file a claim. It has nothing to do with your roof. The third layer is aerial imagery. Satellite cameras photograph your house. Algorithms scan for roof discoloration, debris accumulation, moss growth, structural sag. Bernie Birnbaum documented in 2023 that insurers act on these satellite flags without ever sending a physical inspector to your property. Colorado's Division of Insurance fined 3 insurers in December 2022 specifically for this practice. Non-renewals triggered by satellite imagery. No inspector, no conversation, no warning. Each layer feeds into a composite underwriting score. The insurer buys that score as a finished product. A number arrives, a decision follows. The homeowner sees none of it. Not the clue entries, not the satellite flag. Not the composite score. The Fair Credit Reporting Act gives you the right to request your clue report. But it does not require insurers to show you the score they purchased or explain how it was weighted. LexisNexis charges insurers for every query. Verisk Analytics charges for aerial imagery analysis. A third-party ecosystem built entirely around predicting your risk and billing the companies that use it to price you out. So who built this infrastructure? And who profits every time an insurer pulls your file? That question leads somewhere specific. The answer involves a market structure with almost no competition. LexisNexis Risk Solutions is not a name most homeowners have ever heard. That is exactly how the company prefers it. LexisNexis operates the Clue database, the comprehensive loss underwriting exchange, and according to their own product documentation, that database reaches 99% of U.S. home insurers. Every claim you file, every inquiry a neighbor makes, every loss event connected to your address gets logged, then sold. In January 2023, the Federal Trade Commission required LexisNexis to overhaul its procedures after finding violations of the Fair Credit Reporting Act. Errors in clue reports had affected underwriting decisions for homeowners who had no idea a report even existed on their property. The CFPB complaint database tells the same story in plain numbers. Thousands of consumers have filed disputes over clue inaccuracies. Wrong claim amounts, claims attached to the wrong address. Incidents from previous owners still haunting a property years after the sale. Then there is Verisk Analytics. Their 2023 annual report, filed with the SEC, shows property intelligence revenue exceeding $1.5 billion. Verisk sells aerial imagery scoring to insurers. Satellite analysis flags roof condition, overhanging trees and surface wear without a single inspector ever setting foot on your property. Colorado's Division of Insurance fined 3 insurers in December 2022 specifically for non-renewing policies based on that aerial imagery alone, without physical inspection to confirm the findings. The exits came fast. State Farm stopped accepting new California homeowner applications in May 2022. Allstate followed in March 2023. Farmers left Florida entirely in July 2023, dropping over 100,000 policies after 95 years in the state. California Insurance Commissioner Ricardo Lara issued emergency regulations in August 2024 restricting aerial imagery use and banning credit-based scoring for non-renewals. Florida's commissioner approved emergency rate increases averaging 40% during the same window insurers were walking out the door. Which brings the real question into focus. If these companies left because the risk was too high, who exactly are the customers they kept? And why are those customers now paying more? That premium increase on claim-free homeowners in the same zip codes the insurers just abandoned is not random. The math behind it is the next piece of this story. Here is what regulators knew and when they knew it. The National Association of Insurance Commissioners published a formal report in 2020 flagging the use of big data and artificial intelligence in underwriting. State regulators read it, federal officials received copies. The warnings were not subtle. Nothing changed. No federal standard for disputing your clue report exists today. The Fair Credit Reporting Act technically covers clue, but only partially. A consumer disputing a credit card error has more legal protection than a homeowner disputing the data score that just ended their coverage. That is not an accident. That is a gap the insurance industry has spent years not closing. Then the exit started. State Farm stopped writing new homeowner policies in California in May 2022. Allstate followed in March 2023. Farmers insurance dropped over 100,000 Florida policyholders in July 2023, after 95 years in the state. These were not struggling regional carriers. These were the largest names in American insurance, walking out the door simultaneously. When the private market leaves, someone has to absorb the risk. In Florida, that someone is Citizens Property Insurance, a state-created insurer of last resort. Citizens now carries over 1.2 million policies, according to the Florida Office of Insurance Regulation annual report. It was never designed to hold that volume. Doug Heller of the Consumer Federation of America testified before Congress in 2023 that claim-free homeowners with lower credit scores were paying dramatically higher premiums or losing coverage entirely. The scoring infrastructure driving those decisions did not pause when private insurers exited. It kept running. LexisNexis sells its data products to Citizens Property Insurance. The same scoring system that helped private insurers identify and shed risk now feeds the insurer absorbing that exact risk. The data vendors collect fees on every policy, including the policies nobody else would write. The next question is the one nobody in this industry wants answered. What happens when Citizens itself cannot hold the weight? That letter in your mailbox was not about your risk. It was about your profitability score. And now you know the difference. So here is what to do about it. First, request your clue report. LexisNexis is legally required under the Fair Credit Reporting Act to give you one free copy every 12 months. Go directly to the LexisNexis Consumer Disclosure Portal and request it. No middleman, no fee. The report lists every property claim attached to your address for the past 7 years, including claims filed by previous owners. Read every line. Second, dispute any error in writing. If something on that report is wrong, a claim you never filed, a date that does not match, a property that is not yours, send a written dispute by certified mail and keep the receipt. The Fair Credit Reporting Act requires LexisNexis to complete its investigation within 30 days. Certified mail creates a paper trail. A verbal complaint does not. Third, if your insurer non-renews you, file a complaint with your state insurance commissioner and demand the specific underwriting reason in writing. Most states legally require insurers to provide it. That reason is your evidence. Doug Heller at the Consumer Federation of America has testified that without that written reason, homeowners cannot challenge decisions that were never explained. 3 steps: 1 federal law, 1 government complaint portal, 1 certified mail receipt. A homeowner who paid premiums for 11 years without a single claim can be dropped because a satellite detected a shadow on their roof. That is not an edge case. Colorado regulators documented it in December 2022 and fined the insurers responsible. The machine is real, now you know how to push back. Subscribe, a new breakdown like this every day.